This is Mark Brown with Brown and Company, and I want to welcome you to our Recession Prep webinar. We have been working on this new tool since last fall and have customized it to all of our clients, but we also wanted to extend it out to our full community, and that's why we're having this webinar. We're always thinking of new tools that we can help express to our clients that they're going to have a successful retirement, really through thick and thin. My teammate that helped develop this tool, his name is Chad Hamilton. He's going to be the main presenter today. And just by way of background with Chad had worked for me about 20 years ago for about 10 years. And he's a very experienced investment advisor and financial planner, and left about 10 years ago to pursue other career opportunities. And just at the beginning of the year, we reconnected really, and Chad has rejoined me as a full-time director of practice management. So he's super smart, very thoughtful man, and glad that he's joined our team. So with that, Chad, take us off.
Thanks, Mark. Yeah, just a couple things. So our presentation will be about 30 minutes or so, and then we'll open it up for questions at the end. But in the meantime, if you have any questions, you can actually submit those at any time along the way. If you take your cursor down to the bottom of the screen, you'll see a little icon appear there, and that allows you to submit a question. We'll address those so right at the beginning, like I said, when we open it up for Q&A at the end here. Now, as we get started, we're going to give you an overview of the three main points we're going to cover. But before we do that, I want to be clear about what we're not saying. So what we're not saying, and the reason I say that, you see the header here, right? Ready for a recession. What we're not saying is that we know what's going to happen in the stock market over the next several weeks or months. We're not trying to channel the talking heads on TV or my LinkedIn feed who have been predicting an imminent bear market every day for the last 3 years, okay? We're not market prognosticators, we're planners. And that's important because planning, by definition, financial planning is about preparing for all sorts of different contingencies. You look out on all the various what-if scenarios and try to guard against those types of things capsizing your plan. And after more than a decade of the current economic expansion, and right now, where we're in the midst of one of the longest bull markets in history, we just want to make sure that our clients are prepared for the next recession, whether that happens in 5 months or 5 years from now. So as I mentioned, we've got 3 bullet points on our agenda. We're going to first talk about and take a walk down memory lane to recall the Great Recession from a decade ago, as well as current market volatility we're seeing, and look at the practical implications of that, particularly for those that are at or near retirement. Second, we'll highlight some common mistakes we've seen investors make over and over again and help talk to you about how you can prepare and prevent some of those. As Mark alluded to, we'll, in that second section, look at our recession prep checklist as well as the corresponding scorecard that we've developed. And then we're also going to talk about some tactical allocation changes we've been making in hopes of cushioning a downturn a bit. And then lastly, as we close out, we'll take a step back, look at the big picture, and consider market trends over the long term and implications for all of us as investors. Now, we'll start this off by going back in time. I know at least some of you were around back in late 2008, early 2009, when we did a series of client webinars on the market outlook. And of course, it was a very different time back then. We used some magazine covers. That's why I show these to give context. But at that time, we were trying to show and help walk through what felt like in some ways the end of the world financially. The main point was to say that regardless of how you might feel about it, we didn't think it would be wise to sell. or let emotions drive that decision making, but rather remain focused on the long term, even in the midst of that crisis. And it is hard to overstate just how dire things felt back then. The Dow Jones was below 6,500 on March 9, 2009. Okay, and emotions play a big role in how we think about investing. I'm sure a lot of you are familiar with at least some version of a chart like this showing the emotional life cycle of investing. So what are the things that people say when the market is down? Well, I've been in the industry for over 20 years. Mark's been doing this for more than 30. Justin for a couple decades as well. And time again, we've heard clients say things like, shouldn't we sit on the sidelines until things settle down? Or, I know I shouldn't sell at a loss, but I can't justify investing when things are this bad. Now, those are the moments of maximum opportunity. The best investors are contrarian. The best investors love situations where panic is full-blown and conditions appear utterly certain to get worse. On the flip side, for the successful investor, the time of maximum risk, the time to worry, is when no one seems worried, not when everyone does. We're seeing headlines today where this is on track to be the best week so far this year for the market. So this is certainly a time where we're seeing those stronger, more positive headlines. Now, here's a quote from Warren Buffett from back in October 2008. And we actually used this and talked through this in our webinars back when Buffett said this in late 2008. And we thought it was good then. It's been certainly prescient looking back on it. But he said, let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over. So what has the market done in the 10.5 years since Buffett said that? Well, if you include dividends and assume those are reinvested, the S&P 500 is up more than 13% a year. That's the equivalent of nearly quadrupling an investment in the S&P in a little more than a decade. But here's the thing we want to point out. Why does Buffett say that the market will move higher well before sentiment or the economy? He's pointing out an important idea that the economy and the stock market are two different things. The market tends to move ahead of the overall economy. So here are a couple recent headlines, and you can see it's a very different situation than those magazine covers we showed earlier. The job market's very strong. The stock market, though volatile over the last 6 months, has been experiencing a solid upward trend for a long time now. It's very easy in the midst of this long bull market to conflate the market and the economy. And the same thing for when things are going poorly. When you have an extended period of time, they tend to correlate. But the key is what happens when you're in a period of transition. And that's when you start to see a dichotomy potentially. That's when things start to change, it's the markets that can move first, even in the midst of potentially good economic headlines. And that's what we're depicting on this chart, just showing that a market downturn can begin even while economic headlines are strong. And then sometimes, you see the market take place, and only after that, after a correction, are signs of economic maybe GDP growth starts to slow, economic rate rise, unemployment rate rises, and then eventually a recession. Now, here's a chart that I think is fascinating. So this shows the performance of the S&P 500, that's the white line, and compares it against the primary measure of consumer confidence, which is the Consumer Sentiment Index from the University of Michigan. And it's incredible because those two measurements over this 10+ year period essentially move in lockstep with one another. You can see here when the market was at its lows, that's the same time when consumer sentiment confidence was at its lows. And conversely, when the market's at its highs, you see sentiment move right along with it. Now, what's the takeaway from that? Well, if you invest according to how you feel, or at least according to how most people feel, you're going to sell low and buy high, which of course is the exact opposite of what successful investing is all about. And interestingly, there's a headline. This is from 3 weeks ago. This is May 17, 2019. U.S. consumer sentiment surges to highest level in 15 years. That's what led Benjamin Graham, this whole thing that we're talking about, who's considered the father of value investing, to say this: individuals who cannot master their emotions are ill-suited to profit from the investment process. Now, Dalbar is a company that has been researching and evaluating consumer behavior, investor behavior on investment performance for many years now. And this is a chart that shows 20-year history ending in the end of 2016. And what it shows is the S&P 500 stock index performance annualized. It's just over 10% over that 20-year period. And it compares that's the blue bar, with this orange bar, which is the average stock fund investor's performance, which is just under 4%. Now, that's not the average investor, because you could chalk that up to, well, maybe there are bonds in there. It's trying to look apples to apples at stock investments to stock investments. So it's incredible. There's over a 60% underperformance, or what's been dubbed the investor behavior penalty.
Which is what? What does that mean?
So that behavior basically corresponds to emotions, corresponds to saying, based on how I feel, that's going to dictate whether or not I pull money in or out of the market. And because of investors doing the exact opposite of what they should be doing, trying to buy when they feel good and sell when they feel terribly, that's leading to that 60% underperformance. Now, here's a little clip. Okay, so what do you do about it? How do you prevent emotions from taking over and wreaking havoc on your portfolio? Well, one thing you can do is do the opposite. And I can think of no better example than George Costanza from Seinfeld. So this 1-minute clip.
George, that woman just looked at you.
So what? What am I supposed to do?
Go talk to her.
Elaine, bald men with no jobs and no money who live with their parents don't approach strange women.
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes, I will do the opposite. I used to sit here and do nothing and regret it for the rest of the day. So now I will do the opposite, and I will do something. Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
George.
Okay. So for George Costanza, that actually worked out really well for him. Everything panned out when he did the opposite. I'm not so optimistic for the rest of us. So if the George Costanza option is off the table, what then? Well, I think the best advice is to have a plan. When you have a financial plan in place, it allows for some level of control over your situation so you can better understand the ramifications of everything. Without a plan, and we show this on the left-hand side, we say that you tend to be passive, spontaneous, reactive. You can feel completely out of control. And with the plan, it's just the opposite. There's a level of intentionality and proactiveness and in control as well, at least to a certain extent, that you have when there's planning as a context to all of this investment decision making. Now, here's our current framework for some of the planning we're doing. And we found that one of the most helpful ways to do this is when you think about retirement security in light of negative contingencies, organize potential changes into 3 categories. So first, it's asset allocation, discretionary expenses. It's those things that you have total control over. And then we want to look at the things that you have some control, like your income tax burden, assets available, amount of liquidity, where you do have the ability to move the lever at least a little bit. And then lastly, we want to take into consideration those things over which you have no control and no ability to influence. Think about macroeconomic changes, tax policy, legislation. And that's how we organize it. And then what we do, so the first step is we want to make the most of the things that you can control. And then we want to look at and evaluate these factors that are somewhat or completely out of your control. And then secondly, we have a number of different proprietary tools we've developed, and we want to utilize those to evaluate the effects of various strategies and contingencies on your situation. Now, I'm going to get into a few more examples on the next slide, but big picture, we have our withdrawal stress test, the Retirement Balancing Act, we have a tax filter, and a retirement shock absorber, all in different ways that come into play here and help address these different concerns and aspects to a plan. So we took all of that recession prep checklist and developed what we call our recession prep scorecard. It's just a way to quantify your preparedness for a market downturn on a scale of 0 to 10. And the scoring's relative to your situation. So I know we have a lot of clients on the call. If you received a scorecard, if we haven't had a chance to talk about that yet, there's no objectively good or bad score. It's more of a gauge so you can see whether there may be opportunities for you to take action and potentially strengthen your plan. And by the way, we'd love to talk through that with you if we haven't thus far. If you haven't had one for you yet, we can talk about putting one together. But I just want to talk big picture about the thought process here. So one way to think about this is like doing a fire drill on your current financial situation in order to assess strengths and potential weaknesses of your plan. So do you have enough liquidity available or what we call dry powder to be opportunistic during a downturn? Have you reviewed your stock to bond exposure and your allocation to determine whether it's in line with your risk tolerance, whether we need to rebalance to get back to initial allocation targets? In terms of cash flow, we want to evaluate what you're currently spending and compare it to, as well as what you'll be spending in the future. Here in the middle here, we look at evaluating your comprehensive balance sheet. So do you have debts that could be paid off? Would it make sense to turn on additional sources of income, pensions, annuities, Social Security? Do you have what Mark likes to call secret weapons? That would be, just an example of that would be a vacation home that could be sold to fund retirement needs. And then we want to model the impact of a downturn. So that's one of those things you have no control over. And that's where our retirement shock absorber comes into play to give you peace of mind in the midst of some market downturns to be able to weather the storm. And then lastly, you want to know how much of your cash flow need is being met from dividends and interest created from your portfolio. Now, those changes in the scorecard that we mentioned are primarily personalized. Those are dependent on your situation and your circumstances and goals. But we are doing some broader scale changes in our portfolio. So one of the things we're doing is, and have done recently, is we've made a shift of equities from large growth to large value. This isn't a massive shift. This is a few percentage points. But what we're doing there, the end result is increasing our allocation to dividend-focused stocks. Large growth has served us really well. We've had an overweight in large U.S. growth stocks, and they've outperformed significantly over the past several years. But there is more inherent risk to growth. And so we're just shaving that position a little bit, trimming it a bit. Another shift we've made is from higher yield bonds to high quality. Again, we're not eliminating high yield, but we are making a shift there. And what that does is increases the credit quality of our fixed income portfolio, which again is a stabilizer when we see some sort of market downturn. The last thing we'd say is, and this is more on an individualized basis, but some kind of shift, we're saying 5 to 10% here, it's situational, but a shift from stocks to bonds, at least something to consider in order to reduce your downside risk. Now, the next slide is meant to show that. We have some analytics software where we're able to go in and look at a typical 60-40 portfolio and a 50-50 portfolio and see what that looks like. So when I say 60-40, 60% equities, 40% bonds, and then assuming a 5% shift to a more conservative allocation from 60 to 50% equities. The main thing here, because I don't want to get lost in all the numbers, is really these arrows. And what that shows is the potential downside of this 60-40 portfolio versus a 50-50. Now, this is a really worst case downside, at least in the worst in modern times that we've seen. It's the peak to trough downturn that starts from September 1, 2008 and goes through March 9, 2009. So when you see a 30% downside, we're really trying to stress test worst case here. And what we're showing is with that shift, we're able to cushion the downside a bit from 30% to 24%. And the exchange there is you cap the upside a little bit as well. This is an expected return for 5 years. So if you annualize that, it's just around 7% per year annualized on a 60-40 as compared to a 6% return if that's adjusted. It's not the precision around these numbers. I mean, they're just numbers, and you know, that's never going to be something that you want to rely on. But what it is it does give some directional accuracy and shows you proportionally what that type of move could look like.
Well, we wouldn't want to 50-50 forever, just for right now.
And Mark makes a good point. So we wouldn't want to remain 50-50, right? This isn't saying we're making a permanent change. This goes back to that term that we had earlier, dry powder, or the liquidity available. And what it does is it allows us to be opportunistic. So if we were to trim now, where we're at really high levels in the market historically, and we see a pullback, it could be an opportunity to then shift back to equities a bit. We're not talking about massive changes here, but again, a little bit on the margins could help. So, you know, being proactive and tactical matters, right? That's why we're talking about these things. But it's also important to take a step back. You know, we wouldn't want to stop there because we could easily miss the big picture. Now, this chart, and don't worry about the details so much, but it's more the trajectory. What this chart shows is a massive return over time. This is a 50-year time period that's showing the S&P 500 index going back to June 1969. And as you can see, the index was below 100 then, all the way through last month. So just a massive upturn in the market. If you look at on an annualized basis, you'd earn just over 10% annualized return if you include dividends over that time period. And then along these same lines, you know, if you look at the market over a 92-year period, there were 68 positive years and only 24 negative ones. So 3/4 of the time, the market's positive. Now, any gambler would take those odds. Nearly 3 out of 4 times you win if you're betting on the market. So it is really important to understand that. And the reason we say that is it's pretty easy to succumb to cynicism and pessimism in the current environment. I mean, first of all, the news cycle thrives on negativity and fear. So there's going to be a bias toward that. But also, nearly 60% of people believe the U.S. is on the wrong track. All these measurements of trust in institutions are at or near all-time lows. And you know, we could go on. But if you extrapolate that out into the future, your perspective can get pretty bleak. Now, as an investor, here's why that matters. The problem with succumbing to cynicism and negativity is it can invalidate the whole premise of long-term planning and investing. Because after all, if you invest for the long run, but you believe the system is doomed in the long run, that's a problem, right? You can't have conviction in that. Now, recent polls show a majority of younger Americans actually have a negative view of capitalism, and that's trending. That's true for population as a whole, that negative trend in beliefs around capitalism and the free markets. Now, a helpful way to remain rationally optimistic is to look at charts like that and look at all the different events over time. We actually have a chart. At some point you just run out of space and ability to show everything, right? We have a chart that goes through all of these events in history and what we've come through. And that's what led the economist James Buchanan to say, when I look to the future, I'm a pessimist. But when I look to the past, I'm an optimist. Now, as we get close to closing this out here, I want to show one more video. This is how Milton Friedman, 40 years ago, answered the question pertaining to the problems of capitalism. It's still just as relevant today as it was back then.
When you see around the globe the maldistribution of wealth, the desperate plight of millions of people in underdeveloped countries, when you see so few haves and so many have-nots, when you see the greed and the concentration of power within, did you ever have a moment of doubt about capitalism and whether greed's a good idea to run on?
Well, first of all, tell me, is there some society you know that doesn't run on greed? You think Russia doesn't run on greed? You think China doesn't run on greed? What is greed? Of course, none of us are greedy. It's only the other fellow who's greedy. The world runs on individuals pursuing their separate interests. The great achievements of civilization have not come from government bureaus. Einstein didn't construct his theory under order from a bureaucrat. Henry Ford didn't revolutionize the automobile industry that way. In the only cases in which the masses have escaped from the kind of grinding poverty you're talking about, the only cases in recorded history are where they have had capitalism and largely free trade. If you want to know where the masses are worst off, it's exactly in the kinds of societies that depart from that. So that the record of history is absolutely crystal clear that there is no alternative way so far discovered of improving the lot of the ordinary people that can hold a candle to the productive activities that are unleashed by a free enterprise system.
But it seems to reward not virtue as much as ability to manipulate the system.
And what does reward virtue? You think the communist commissar rewards virtue? You think a Hitler rewards virtue? You think, excuse me, if you'll pardon me, do you think American presidents reward virtue? Do they choose their appointees on the basis of the virtue of the people appointed or on the basis of their political clout? Is it really true that political self-interest is nobler somehow than economic self-interest? You know, I think you're taking a lot of things for granted. And just tell me where in the world you find these angels who are going to organize society for us. Well, I don't even trust you to do that.
All right. So it's not particularly fashionable to defend the free markets at this point in time, but we think it's important anyway. The reason why is successful investing requires conviction. And in order to have conviction, you need to stick with a plan for the long run, and you need to have confidence in the underlying economy. Another way to say it is, you think about an iceberg analogy, right? So if behavior is the part of the iceberg you see, there's all these beliefs underneath it that drive a lot of that. Now, we have sort of a framework we've developed where in this chart where we say there's two different sets of views on the economy that comprise an investor's perspective on the markets. Optimism versus pessimism, and skepticism versus trend following. Now, in economic terms, optimism means you have a fundamental belief in our underlying economic system. You can have confidence in the markets over the long run because of it. Economic pessimism is the opposite. You lack trust and confidence in the economy and markets, and therefore you don't take comfort in long-term planning and viewpoints. At Brown & Company, we believe in being sort of skeptic or cautious optimists. That means we hold in tension two somewhat different outlooks. On the one hand, we're optimistic about the capitalist system, which gives us conviction and long-term perspective. At the same time, we believe in reversion to the mean. What goes up must come down because the economy and the markets move in cycles. And those types of investments that have underperformed in the past will inevitably, at some point, outperform in the future and vice versa. So it's the optimism coupled with the lack of predictive ability to time the markets that allows us to remain invested through economic cycles, but it's the cautious skepticism that advises being proactive in preparing for a market downturn. So we just wanted to close there because that gives you a sense of our perspective. We just kind of articulated it there on the left-hand side of the screen. And with that, I want to thank you, first of all, for joining our call. We hope it's been helpful. And now we'll take any questions you may have at this point. We actually had a couple come in during our webinar, so we'll address those first. But if you have any questions, just type those in and send them to us. Like I said, it's right at the bottom of your screen. You should be able to see that icon, and you can submit whatever questions you'd like. We also encourage you to call, email, and follow up with us individually if you'd like to do that. But here are a couple things that people ask along the way. And a lot of times, like with any question, they may be pertinent to more than just the person asking. So hopefully these are helpful for everyone. One of the questions, well, this is an easy one. Can I get a copy of the slides? Yes, we'll actually email the slides and a link to the recording to this presentation to everyone that registered for this call. Now, it may be next week before we get that and have the recording, but you can expect to see that soon. Another question that came in, do you only do recession prep scorecards for existing clients? No, we'll put one together for anyone on here that's interested. In fact, if you have someone you know that might be interested, I mean, you know, it never hurts to get a second opinion, right? It never hurts to have someone else look at your situation with a fresh set of eyes and maybe see something you hadn't seen or maybe another advisor hadn't seen. So we're happy to do that. We would just need some financial information in order to put that together for you. We've got another question here. Let's see. Should a portfolio have some hedging for a downturn?
We didn't talk about that, but so this is Mark. Part of that scorecard and checklist, one of the items, you know, to have a higher score is to have some hedges in your portfolio. And, you know, hedges are basically investments that don't correlate with other investments, so especially the stock market. And we like to see about 20 to 25% of our client portfolios in some sort of hedged vehicle. And that's especially important right this minute. So if you don't have hedges in your portfolio, we certainly encourage you to do so and talk to us about that.
And I'm so glad that question was asked. There's always one thing or two things you get done with a presentation, you say, kind of forgot that piece. We talked about allocation, big picture, but we didn't get into to that specific piece of it. Oh, here's another question that came in. If you were invested 100% in conservative bonds since 2008, what would be the performance relative to the S&P 500 index?
Not good.
Not good at all. Maybe we can have someone run that, but we'll see. I don't know how quickly we can pull that up, but we can definitely.
It's probably a third of the market.
I mean, I'd be surprised if it's that much.
Yeah.
Just because of how strong the market was.
You know, in a perfect, you know, sort of vacuum, even like institutions, if you don't have any need for cash flow or you have an unlimited time horizon, you're always going to be best off having, you know, historically 100% stocks. Now, whether you can stomach that is a whole different, you know, question. But we find, you know, some of our older clients, even like Depression era clients that went through some tough times, they'll have a whole 100% stock portfolio for their whole life because they really believe in equity investing, and they always, you know, at the end have the most money. So we use bonds as a necessary hedge, just so that people can feel comfortable going through the ups and downs of life in the market without having that much volatility.
And we actually had a colleague here run those numbers. So what is that? The Barclays aggregate bond index. So the broad bond index over 10 years did 3.65% annualized. The S&P, it might not be exactly the same time frame, but the number that I used was 13%. So roughly 13% versus 3.5% with bonds.
That's pretty close.
Yeah. I just pulled this up on the screen too. So here's our scorecard. Just get back to the alternatives piece. That's where we talk about and score the hedged, whether you call it hedged or alternative investments. We're looking at those types of investments that are not correlated or very have a very low correlation to stocks or bonds.
Any other questions? Chad?
Doesn't
matter. Doesn't matter.
I think that's it. Do we have any other questions that come in? Okay. Well, if you do, we encourage you to reach out to us. We, again, really appreciative of all of you for taking time out of your day to join us. Give us any feedback you have, good, bad, or otherwise, and we'll follow up. So you will get a copy of the slides and a recording of this presentation. And thanks so much.
Have a good weekend. Thank you.